Mike Wright here, Red Shoe Business Club. It's Tuesday, the 17th of October. I'm getting the dates right finally. Just had an interesting experience where when I tried to log into Facebook Live, Facebook told me that I couldn't log in because I was doing it too often, and so I needed to protect you all from spam. So I'm sorry if you feel like I'm spamming you, but I thought a daily event wouldn't be a bad one after all. I'm going to have to move something. I see my camera is facing the wrong direction. It's more important that you see the board than that you see the certificates behind me. So anyway, well, the Red Shoe Business Club, as you know, is sponsored by Tax Right, which is the business I own and operate on. We got through the tax deadline. There's a not-for-profit tax deadline coming up in November, and then we can sit back and deal with these issues coming after the first of the year. So we're ready to go. And you'll remember yesterday we talked about the deductions. We spent some time talking about ordinary and necessary expenses. And I will revisit that off and on because it's an important issue, particularly when you're trying to get your taxes done and you're trying to decide whether or not a particular expense is something that you can deduct. My feeling in general is that if it relates directly to your business, there should be no question that it's deductible. But one question about the deductibility has to do with, can you deduct it all at once, or do you have to stretch it over time? There are many types of things that you buy for business that you will use over several years. These are called capital expenditures. Capital expenses. This is simply something that has been created over time because what the tax people want and what bookkeepers want as well is the idea that the expense should be closely associated with the income that it is the result of. In business, you only spend money to make income. Even in a not-for-profit, you only spend money other than what you do to accomplish your mission as a not-for-profit. You only spend money to make more money. So something that you're going to use over several years ought to have the expense of it stretched out over several years, the theory goes. This is where the concept of depreciation comes from. And its related idea of amortization. I misspelled that, got two I's in amortization. Depreciation relates to physical objects. Amortization relates to financial objects. For the best example I can give you, and the most common example of amortization, has to do with expenses that you pay for the startup of a business. Under current tax law, if you have startup expenses, the first $5,000 can be deducted in the first year. The remainder, the amount that's left over above $5,000, has to be amortized. In other words, one portion taken out over the next 5 years. So 1/5 each year for the next 5 years. Unless you sell the business or it goes bankrupt, in which you can collect all of the rest of the amortization that would have been paid if the business had continued to operate. So just remember that these two concepts are related, but what it boils down to is exactly the same thing. In depreciation, a portion of the cost of the item is deducted in 1 year, and a portion of that is deducted the next year, and the next year, and the next year, and the next year. Based upon the kind of item that you're dealing with, the depreciation will be stretched over anywhere from 5 to 35 years. There are even some kinds of property that are depreciated over 50 years. The most common levels of depreciation are 5 years. And this is autos, computers, machinery, things like that. 7 year, there's some overlap. Also machinery, equipment that you purchase, office equipment, things like that. These two categories, you have to be sure to check the listings from the IRS to determine which one it goes into. But in each case, the value of the item has to be a piece taken out every year over the several years that it's responsible for. Real estate is different. In real estate, we have 27.5 years for residential and 35 years for commercial. $27.5 years for residential, 35 years for commercial. One of the things that you want to remember is that land does not depreciate. If land does not depreciate, then you can take off the land right away because it does not depreciate. Some kinds of equipment, which comes in pieces and parts, like large manufacturing devices, that'll have controlling pieces, they'll have individual stamps or levers or different parts. These can also be segregated out and depreciated individually, so that when the item is sold, replaced, then your depreciation can start again. So there are also some techniques that you can use to bring some of the replaceable items out of depreciation and write them all off in 1 year. Why do you want to write them all off in 1 year? Well, obviously because you get a bigger bang for your buck. Instead of being able to write off a $30,000 building 1 year, you have to take off 127.5 over 30th of that value each year. We also complicate it with some other issues, such as whether we do it mid-year or mid-month. And the first year and the last year that an item is depreciated, it's almost always depreciated by the half year. Also, when you start up a business during part of the year, for depreciation purposes, we'll use the short year for that calculation. So that is the essence of what depreciation is one small piece each year. However, because it is to the advantages of the tax departments, or to the government gives businesses the benefit of things called accelerated depreciation. Accelerated depreciation, and there are a variety of schemes for that, and I'm not going to go into all of them, is like this. If we take 1/5 of the price of something each year and deduct that 1/5 each year, that's called straight line depreciation. Accelerated depreciation allows you to take off more the first year, a little bit less the next year, a little bit less again the year after that, and a little so on down until the item is fully depreciated. The double declining balance technique is the most common, but there are several others. They all amount to what's called accelerated depreciation. The idea being that from the tax standpoint, it encourages businesses to buy stuff so that it encourages businesses to invest more, produce more, And in order to encourage that, they cut their taxes for that particular year. More recently, because of an even more aggressive technique in this, we've done special depreciation allowances, which have allowed businesses to take almost all kinds of items other than real estate to take 100% of the cost off in 1 year. And so you get that full amount all at once, and so you have that powerful impact. There is a movement afoot, and I won't go into the logic of it right now because it would take us a whole hour or more. But the idea is if we could make that special depreciation allowance technique universal and permanent, then it would encourage even more purchases because businesses could deduct things all at once. This special depreciation allowance technique is intended to go away at the end of 2025. So watch for that, see what Congress does to change that. I'm getting short on time here, and there's a lot more to talk about, so I think I'm going to wrap it up here because I'm going to talk tomorrow about the exceptions to the depreciation rules. The reason I'm spending so much time on this is because this is something that's going to have an impact later on when we talk about financing and when we talk about how we compare state tax laws with the federal tax laws. So for today, I want you to remember the idea of depreciation and amortization are the same thing, that we use several years to depreciate things, that real estate has much longer depreciable periods, and finally, that we actually use something different than straight line depreciation. You always use straight line depreciation for real estate. But for other things, we can do various kinds of accelerated depreciation and the special depreciation allowance. And as a teaser for tomorrow, if you've ever had somebody talk to you about a Section 179 expense, that's an important thing, and that's what we'll talk about tomorrow. So for today, that's depreciation 2. Tomorrow will be depreciation 3.